One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to the Investment Banking Insights podcast. My name is Alex Mason and I am your host. This is the show where we study the essential technical and non-technical information that you need to know in preparing for recruiting for investment banking. That's my purpose with the show. That's my mission. That's why I'm doing this. And I am an incoming MBA student, probably just like you, trying to figure all this stuff out, especially those of you like me who come from a non-finance background. So we're going to be diving into all the things that you need to know. We've covered in the first 7 episodes of this show a lot of the general things that you're going to have to know, both in terms of behavioral questions that you're very, very likely to be asked, as well as just an overview of the industry and the recruiting process and what investment banking actually is at a high level. So now that we've got all those background things out of the way, I want to talk about accounting now. It's actually time to dig into it. And never fear for my non-math folks out there, it's actually not that bad. It's really about concepts. It's about logic. As far as I've dug into it so far, it's really just about understanding terms and how things work together. So without further ado, let's go ahead and talk now about some basic accounting principles. All right. Well, the first thing that we need to know is, what is accounting and what is it for? Accounting was invented to measure things in a consistent, repeatable way in order to basically understand how money flows in a business. That's really why accounting was invented. If people didn't use accounting, there would be cheating, there would be lying, there would be stealing. It would be really, really hard to trust transactions because we wouldn't understand the record of where things go and how much we should measure. So accounting is essential for our financial system and really for our society. So it's a really important function. And it's important to understand that accounting only deals with things that can be measured. It does not deal with a lot of the qualitative things that we cannot measure with numbers. So I should say that you can measure things with numbers, and you can also measure things with things that are not numbers. Accounting only deals with numbers. It's a number-based field. So keep that in mind. And that kind of drives everything about how it works. Another concept that is important to understand is the concept of historical costs. So let's say that you and I start a business and we want to run a pizza franchise. I've always kind of like had this dream of like running a pizza franchise. Anyway, you and I are going to business together and we own this pizza franchise and we want to buy a building because we need a building in order to be our storefront as well as to make the pizzas. So we buy this building for $200,000. And let's say that we bought it 5 years ago for that price. Now, fast forward to today, that building is probably worth more than $200,000, but we paid $200,000 for it. And that is a known quantity because the transaction actually took place. So on our books, on our accounting books, the balance sheet specifically, which we'll get into in a couple of episodes, we would record the value of that building at $200,000. And that would not change until we decided to sell the building. And it's important to understand this because if we try to account for the value of the building at some other number, it might not be completely accurate because, well, we don't really know. We haven't sold the building yet. We'd have to maybe get it appraised. It's a whole different thing as opposed to recording historical costs. So accounting likes to deal with things from a historical basis. Now, another concept that's important to understand is consistency, conservatism, and materiality. And these are three concepts that I want to dig into just for a minute or two. So, first off, we need our accounting to be consistent. It doesn't make sense for one year to account for things in one way and then the next year to account for them in a different way. It's comparing apples to oranges. And we can't really do that because it doesn't lend itself to recognizing trends in a true way. It's kind of like in the field of science or the domain of science, you can't run a scientific experiment without having consistent methodology between experiments because then you can't compare things accurately. Well, it's the same thing with accounting. You want to account for things in a consistent way. So that makes sense, right? And then conservatism, we want to make sure that we're not being aggressive with how we value things. And I'm speaking very generally here without being too specific because there's a lot of minutia involved here. But just so you understand the point, if we try to value things too aggressively, it can lead to a lot of trouble. And one example of this is the famous example of Enron, the energy company from Houston, Texas, which in the early 2000s was a powerhouse on Wall Street. A lot of people own this stock. People put their life savings into this company, and they were too aggressive with their accounting, and they straight up lied about a lot of things in their books. So conservatism in the accounting field is incredibly important because people's money is at stake. If you're too aggressive, then it can cause a lot of problems. So that's conservatism. And then there's the concept of materiality. This was kind of a new one for me reading about it and trying to understand it. Not everything that happens in a business matters enough to put it on the books. And just a quick example so you understand what I mean by this. Imagine you own a corporation that is worth $100 billion. You're doing tens of billions of dollars in sales every year. You have thousands of employees, and you basically own this empire. And let's say that there is a transaction way down in your organization where the value of that transaction is $2.54. Okay, that happened. You paid money for something. You got something for $2.54. It was on the company's dime. Should it be recorded? Absolutely. Are you going to record that at that level all the way up at the financial statements of this large corporation? No, it's not. It's not material. It wouldn't really change anything. It would be akin to a rounding error on a mathematical equation. So materiality is all about what actually matters here, what's actually should be counted, because it's not just about counting things in a conservative way and in a consistent way, but making sure that we're actually not cherry picking things based on our preferences. But if something is considered material, it needs to be included on the books. So those are three concepts that are very important to understand. Let's now turn our attention to another very important concept that I want to spend a couple of minutes talking about. And it is the concept of accrual accounting versus cash accounting. Very important. So, what does this mean? Well, cash accounting is kind of the way you might think about accounting from a very basic sense if you were running a self-employed business by yourself. Let's say that you have a lemonade stand, the classic example, right? You need to buy lemons, you need to buy sugar, you need to have the stand, and then you sell lemonade to customers. They give you money for the lemonade, right? Probably the simplest business example ever. Now, in a cash accounting system, you would record your profit and loss based on how much cash you exchanged over that time. Let's say it took you $20 to set up the stand. You made $30 in a day of sales. So your profit is $10. Super, super simple. Now, what is accrual accounting and why do we use it? Well, accrual accounting essentially accounts for timing and things that don't necessarily affect the actual cash that the business has at a specific moment in time, but nevertheless need to be counted and considered. So here's the best example that I have. So in accrual accounting system, your net worth would go down when you use a credit card, not when you actually pay the bill. So let's say that you're a business, again, using the example of the pizza franchise, and you're in business with me. We say, okay, we need to buy the best pepperoni from the best vendor possible. So we find the vendor and we go ahead and purchase the pepperoni, but we put it on our credit card. So in that system, we now count it as an expense, even though we technically haven't paid the bill yet. We just got the shipment in a pepperoni, and now that's an asset on the books of the corporation. So, okay, we bought this pepperoni, but in accrual accounting, it makes sure that we identify that we have this accounts payable, which I'll get into all these terms in a couple episodes. But essentially, we're accounting for timing. Instead of paying for it with cash, we're paying for it with credit. And that credit is reflected in the financial statements of the organization. And super important because modern corporations, credit is absolutely critical. And virtually everything is bought and sold on credit these days. And so that's probably the simplest example I can give of accrual accounting versus cash accounting. And this has a lot of implications for us, right? Because as investment bankers, we need to understand these differences. Not everything that counts can be counted, and not everything that can be counted counts, right? So we have to understand accounting at a very fundamental level. And accrual accounting is really the best system we have for tracking financial value during the life of a business. Cash accounting is what is used to describe actual money that changes hands, and it can be useful for individuals or for small businesses. But accrual accounting is the standard for any major corporation. It recognizes revenue when a product is shipped or the service is performed, not necessarily when the buyer pays. Remember that credit card example. Also, in accrual accounting, expenses associated with a product or service are matched to the revenue for the product or service over that same period. Let me repeat that. In accrual accounting, expenses associated with the product or service are matched to the revenue for the product or service over the same period. So you have this principle in accounting, which is a matching principle. So if I sell lemonade and I'm using an accrual system now, and I sell some lemonade for $5, let's say, I need to understand the expenses associated with selling that glass of lemonade. And I'm going to record those expenses based on that unit that I sold. Makes sense? I'm not just going to say, "Oh yeah, well I bought 20 pounds of sugar and it cost me $20." I'm going to say, "No, this glass of lemonade, I sold it for $5 and $3 was my per unit cost for that lemonade that I sold. So my per unit profit of lemonade is $2." Something to that effect. So matching is very important in accrual accounting. Now, if you didn't do this matching principle, and this is why this is so important, if you didn't do this, the profits and losses of a company would be much more erratic depending on when you recorded expenses. So using this lemonade example, if I bought those pounds of sugar for $20 and then for a week I sold $10, $15 worth of lemonade, well, for the week, it might look like my corporation was running at a loss because my sugar was so expensive. But that's just because I happened to record that expense of sugar at the beginning of the week. Now, if I record my expense of sugar on a per unit basis, then I can say, okay, for the week, I basically spread out my expenses based on what I've actually sold. Therefore, I'm profitable. So this is why accrual accounting is important. It's all about timing and matching. So accrual accounting accounts for timing and matching of revenue expenses. Cash accounting does not. Cash accounting is just straight up the money that goes in and out. And that's the fundamentals. So these are some basic accounting principles. I hope that you've learned a little bit here in this episode. I'm trying my best to understand and explain this in the clearest way possible. So I hope you enjoyed that. Next time, we're going to be doing a short episode on the basic equation of accounting, the fundamental equation upon which all of accounting rests. It's kind of like, I'm like a science guy, so it's kind of like, the laws of thermodynamics or Newton's laws of motion. It's like these axiomatic things that are so fundamental to the field. Well, yeah, this is it for accounting. Accounting has a basic equation, and we're going to get into that in the next episode. But until then, my name is Alex Mason. I am your host, and you're listening to Investment Banking Insights.